Hello, I'm Adam Grimes and welcome to ChartSchool. So I want to talk about breakout trades today, and I want to show you a specific example. But before we look at the example, let's talk about the trade concept. I want to show you the simplified concept like you would see in a book, and then we'll talk about how this stuff works in real life. So let's just use a upside breakout trade. So I think the way most people think of these trades is we have a market that has shown some type of resistance level, and then we break above it, you buy here at the breakout point, and you make a lot of money. That's kind of how the trade is usually presented. Or in its mirror image, of course, you have a market that has defined some kind of support level, it breaks below it, and you make a lot of money. You short on the breakdown. Now, a couple points here. So first of all, terminology. In my experience, stock traders will tend to call the second trade pretty carefully a breakdown trade. Futures traders, currency traders are likely to think of either one of these as a breakout trade. I think in my speech you'll probably hear me use both, but just be aware that that is a potential difference in the way people label this trade. So this is a breakdown trade in the Swiss franc. Let me show you the simple trade first of all, and then we'll talk about why it wasn't so simple. So you have a market that has defined some kind of support level, whether you draw the level here, or you consider both of those levels to be active. And I think you could make a compelling argument for either one of those being correct. And in fact, in my thinking, it was really the first level, the higher level, that was kind of the first trigger, but I wasn't interested in trading there. So, that's what I want to talk about in a minute, market context. But what you see here is, so we've had a market that's been in some kind of range, and then we have some new downside momentum. Now, it was subtle at first, but I'll tell you, you've always got to be suspicious when people show you charts, particularly the Elliott wave guys. Let me just throw that out there because I've been having some discussions with, let's just say, some Elliott wave idiots. I don't know any other way to put it. And, they're always refitting their waves and showing you how perfectly the waves fit. And, yes, I was there 20 years ago. I did that. But it doesn't work in real time. So you always have to be suspicious when somebody shows you a chart. I will tell you, in this case, though, I'm also on record here in two contexts at least. One, I give analysis practically every day and certainly several times a week for my market life guys and gals, market life clients on currencies. So we've been talking about this, and I will tell you that we clearly saw this. We saw that the market had changed, and I kind of think of myself as really grouchy when I had a failed trade back here. I was looking to buy the Swissy, and then it just went flat. That's where I get grouchy. The failed trade doesn't bother me. I'm fine. I don't remember exactly where the trade was, but I bought somewhere in that area thinking that I was playing off of a weekly bull flag, which at the time, I think, you're back here on the weekly. I still think that was a good trade. It was the right trade to do. And not that trade failed, but then it went very, very flat. And we see the moving average go flat. We see it chop back and forth around the moving average. There were many days I do analysis of all the majors, and then I hit the minors that we really need to pay attention to. But there were many times that I just pulled up the Swissy and I said, we're not even going to talk about this. There's nothing to talk about. And I spent a total of 10 seconds on it and analysis. So that, first of all, when I think of it as being grouchy, but it's a very useful thing. It's a useful framework, because when a market is flat like that, you don't want to be chopping up money. You don't want to be getting caught long short and all the whipsaws. So what we need to wait for is something that looks different. And I believe people can fact check me. I believe that I said that this looked a little bit different, but I thought it was too early to trade. So there was no trade there. And I said, I may regret not taking that trade, but I'm not going to take the trade. However, once we get this little consolidation, that is where it becomes very, very interesting, and that's where we have a trade. So the actual trade, in my opinion, it's kind of a two-tiered breakdown. You have the first breakdown, and that is, you've got to be comfortable missing that first move. psychologically, a lot of people have trouble missing moves, right? I talk to a lot of developing traders that are stressed that the market's going to move without them, and so there's all kinds of psychology around that. The way I have resolved that for myself is I'm perfectly fine missing moves. But what I need to do is, once I've got this move, then what happens? Had we gone down here and snapped back up in here, I stop watching it. We're back to neutral. But if we are able to consolidate lower as we did here, that likely sets up a downside continuation. So several points here. First of all is understanding that when the market is in a range, you don't want to be trading there. You do want to be paying attention, and you want to be paying attention for something that looks different. In my opinion, and other traders will disagree, I don't think you want to take that trade. I don't think you have to take that trade. I don't think, well, look, back here. So let's say you were looking for an upside breakout. Now this bar certainly looks compelling, right? But you don't want to take that trade. You want the market to give you a little bit more information. And look at what information the market gave us just a few bars later. We were back in the range. So I don't have to lose money there, right? I can skip losses. But we did not snap back here. So this is the development of the trade, and you can look to short here. So that is kind of a trade template that I think you can use in all markets, all time frames. Certainly works intraday, works very well. I don't tend to take a lot of breakouts per se because I don't like the volatility around those breakouts. But if I get some consolidation at the breakout level, just before, just beyond, something like that, then the trade to my personal trading style, for my personal trading style, is much more manageable. So there you go, breakdown trade in the US dollar, Swiss franc. I also want to point out, Tom and I launched a new service this week, talonadvisors.com, and if you use the code TalonLaunch25, you can get a 25% discount off a lifetime subscription there. We cover swing trades, long-term trades, portfolio management, currency stocks, individual stocks, options. So go check it out. There's a no-risk trial, and you can cancel anytime within the first month after the trial too. So that's talonadvisors.com. Use the code TalonLaunch25. Thank you very much.